Good afternoon, everybody, and welcome to TradeStation. My name is Michael Burke, and I'm Vice President of Client Training here at TradeStation. And this is another installment of our options trading series with Price Headley. Today, we're going to be talking about swing trading options, but we'll get to Price in just a moment. Please keep in mind that the following presentation is for educational purposes only. All of the symbols and trading ideas discussed by the instructor are for demonstration purposes and are not recommendations. Active trading is not suitable for everyone. Options trading, doubly so. Please look at the risk disclosure information that I'm pushing into the chat. Within this disclosure are also links to the options disclosure, the characteristics and risks of standardized options. That document is also available on a link through that PDF, so definitely take a look at that before you start trading options. So without further ado, it's always a pleasure to have Price here with us. Price is one of the most knowledgeable people I know in the options markets and market analysis and trading, and he brings a really practical approach to his way of looking at the markets and trading, so we always learn something when Price is here. So without further ado, Price, thank you for doing this for us, and it's all yours.
Well, thank you so much, Mike, and great to be with everybody today. And so excited, as always, to do events on these TradeStation webinars because, as you know, I've been a long-time user of TradeStation, and I go back to using TradeStation and its precursors back more than 20 years, back into the early 90s. So it's just a phenomenal tool. I'm going to be showing you some of the things I do with TradeStation and swing trading options over a 2 to 5 day span. I want to first make sure everybody's hearing me okay. So if you could just type in maybe what's your favorite stock you like to trade, or if you like to trade in Forex or futures, what's your favorite vehicle you like to trade? We'll try to take a look at some of those symbols later after I go through the PowerPoint. I'm going to jump into the TradeStation platform. So we've got some futures traders trading the spiders, the SPY, Tesla, one that I'd like to trade as well, Frank, the SPX, the Russell 2000, Intel, the VIX. So lots of different vehicles, and so I'll try to take a look at a variety of those as we get through the presentation. Just as a reminder, of course, everything that I share with you today, even as I look at actual live charts in TradeStation, these are not meant to be specific buy or sell recommendations. Just consider today purely educational, for your information only. You know, you've got to consider what is appropriate for you. So, you know, ultimately, you know that you were solely responsible for your investment decisions. And here are big trends. We seek to be a resource for you to make better decisions, hopefully, for yourself. But ultimately, you know that you're taking on 100% of the responsibility for whatever happens. And that's good. That's a good thing. That's actually something that over time, when you take that accountability, that over time tends to lead to greater levels of effectiveness in trading. It doesn't mean you're not going to still have losing trades. We're going to talk about how we manage losers as well as winners here today. And of course, you know, Big Trends doesn't provide personalized financial, tax, or legal advice, so do consult with your tax advisor before you make any investment that might impact your unique financial and tax situation. Okay, with that behind us, what we're going to focus on today is swing trading. You know, talking about not a quick trade, day trade mentality, but more of about a week or so horizon. Actually, technically, my systems are tested that after the 6th trading day, typically, they would automatically close out even a good trend, because, you know, typically we're looking at a signal effectiveness at which after a certain amount of time, it kind of loses some of that effectiveness. You know, we're focused here on technical analysis. And really zeroing in on the charts, in particular tying it to not just finding the right stock or underlying ETF to trade, but then tying it to an options strategy. So part of what I'm going to share with you today is maybe some things you haven't seen before, such as how to use option charts. You know, an option chart is a unique idea to a lot of people, where you may not have seen the idea of actually tracking the option. Well, TradeStation's been, to me, one of the forerunners in actually keeping options data even after the expiration for a few days. You can go back and study what was working for you, what wasn't working for you when you were in the option trade. You know, you want to trade, you know, the vehicle that you want to track the vehicle that you're actually trading. You don't just want to look at a stock chart and then try to guess which option to trade. So to me, that option chart really helps a lot. We'll also talk about weekly options. So weeklies have become a very powerful vehicle here for really focusing on, the biggest and best opportunities there, and then we'll give you a load of examples. And what I would consider to be a more powerful way to look at charts, which is in multiple time frames. I love how in TradeStation I can line up 3 different time frames. I'm going to focus on the hourly chart here for swing trading, but then we're going to kind of sandwich that in between the bigger picture daily view and also the shorter term 15-minute timing for kind of zeroing in a swing trade into even shorter term, effectiveness. Now, I'm curious if you were typing in one of these numbers 1 through 5 to say what's your preferred time frame. Obviously, we're talking about 2 to 5 days, so that probably attracts a lot of people who would classify themselves as swing traders. But if you do say you're a swing trader, type in the number 2. If you say you're more of a day trader over 1, maybe 2 days, type in the number 1. Number 3 would be more of a position trader out up to a month, usually 1 to 4 weeks. And so we have some swing traders, some day traders, and so we'll put our energy towards those short-term time frames, in particular swing trade, of course. But we'll also show you if you do some position trading, because we do have some folks there, we do have some day trader folks, how you can focus on that. Obviously not attracting, thankfully, the passive investor. Most of you are much more proactive. And if you were an active investor, nobody's typing in the number 4. The Liang is that's cool if you are a passive investor. I would say if you're long-term like that, look at a monthly chart. So what we're really talking about is aligning any chart that you use in TradeStation into your proper time frame for the right holding period. So for me, the number 5, passive investor, look at monthly charts. The number 4, active investor, 1 to 12 months, look at a weekly chart. That typical holding period for me is in the neighborhood of 3 to 6 months usually on a weekly chart. Position traders, I'm using the daily charts, looking out typically about 20 to no more than 30 trading days, about potentially 4 to maximum 6 weeks. Swing traders, like I said, we're going to key on the hourly charts. And then the day trader types, I look at a 15-minute chart. Some people think as day traders, why would I look at such a long-term time frame? Why not look at a 1-minute chart? My issue is that if you get too much noise in your signals, that's going to really hurt your confidence in the quality of your trade. So for me, I don't like to go down below a 15-minute chart. And what I'm going to show you today will still pick it up over about a 1 to 2 day hold on a 15-minute chart. So that, for me, works real nicely. Now, you can decide whatever time frame is appropriate for you. Now, we're going to look at the platform here, and actually, because these charts on the PowerPoint, I think, are a little bit hard to read, especially with the triple time frame. But the main point here is that we've got 3 time frames showing up there. This is a past chart of Google, GOOG. Now, of course, also trading as GOOGL, kind of trading in 2 pieces since they split the stock 2 for 1. But this is an example of one that we picked up as a sell on the daily chart as it started to break down after the gap down after earnings. And we were getting an hourly chart sell in here as well, and we were getting a 15-minute chart sell in here too. So you had 3 different time frames working for you. The main idea of this whole triple time frame method is it's a lot easier to trade when all 3 of those are pointing in the same direction. Sure, you can still make money in a 15-minute chart scalping a bounce back up in a long-term downtrend, or even spiking, for example, today's move. We'll look at on the S&P here in a little bit where the market dropped even though it's been in an uptrend. And we'll talk about where the markets are positioned to go based on the indicators I'm going to share with you today. But we're going to look at the charts in a lot more detail where you can see them even better from my platform here in just a few minutes. Now, option charts. Why would we even want to look at an option chart? Most option traders to this day are still looking at the stock chart and then trying to essentially guess, should they buy an option, which option they should buy, etc. What would happen if you looked at a chart of the options price? Do you think that would look any different than the stock chart? I've even been challenged by some very well-known option strategists out there to say, why are you even bothering looking at an option chart? That sounds like the same thing as the stock. It's just options are just a derivative of the stock, right? This is from well-known options people saying, well, aren't there some key factors here like time and volatility? You know that an option is a time-limited asset. You know that it's going to hit an expiration. If you trade weekly options, they have expirations typically every week. So you've got about typically 7 trading days on those from a Thursday to the next Friday before the weeklies expire. So that's a very short-term time-limited asset. Why would I ever buy that option? Well, I'll show you why in a little bit. But the bottom line is that, volatility, as you know, the more volatile the stock, typically the more you're going to pay for that option, the higher the premium of that option. And so this will make the options chart look very different from a stock chart. Because let's just say you've got a stock chart that's essentially staying flat. I'm not a very good artist, but if you were essentially looking at it and saying, if we were looking at, just your classic plot of your stock chart, you're saying, okay, look, you've got that stock chart, say, going, and essentially, as the stock's going in, say, a flat line, let's just say it's oscillating, but it's really not going anywhere. So I'm just going to draw it as a dotted line flat. What do you think is happening to the option chart as you go from the left to the right on time? What would you guess if you bought the at-the-money option? Say the stock's at 50, you buy the at the money 50 strike call, and the stock's really not moving. Well, guess what's happening to the option? It's doing one of these, right? It's just gradually, that's right, it's falling, and then it's eventually accelerating to nothing right near the expiration, right? So that almost mimics the time decay curve, getting faster and faster decay as you get closer and closer to expiration. So first strategy would be, if you're going to buy options, in my view, especially for short-term trading, swing trading we're talking about here today, I don't like to buy at the money or out of the money options. I'd much rather swing trade buying an in the money option. So first rule of thumb is I like to buy an option that's usually got about at least 2/3 of its value is what we call intrinsic value. I'll show you some examples as we'll look at Option Station and go in and look at some of the montage and show you how that works. So, that's a first rule. Don't buy the wrong kind of option because you'll see sometimes, yes, you can make more money on an at the money or out of the money. And yes, even the option chart can show you that for more aggressive traders. But, typically speaking, we're going to be safer buying in the money and then following appropriate risk reward levels. Now, here I have a chart from the past on the NASDAQ composite. You can just see what we're going to talk about today are a few of the different windows that I look at, looking at a couple of key indicators. And one of them is the percent R, developed by Larry Williams. But what you're going to notice that I look at is these windows of time where percent R actually goes overbought in the top 20% of readings here. And you'll see what happens to the market through those windows. The market will roll on up. We've got a slight stop out there. It hops back in for a little period here and then stopped back out. This is going back several years on the weekly chart. By the way, it also picked up the downside opportunity that happened in late 08. There's the fall of 08. There's the sell signal. I'm picking up a little downtrend in the market there. Now, you can also see the purple bands on the upper chart are my acceleration bands. This is an indicator I developed that frankly helped me launch big trends when I was catching a lot of the accelerations in the late 90s in the tech stocks, the brokerage stocks, some other specialty plays, and essentially capturing just incredible accelerations to the upside during that bull run. So it's worked in both bull and bear periods. It worked to catch, speaking of bear periods, caught Bear Stearns in that March of 08 collapse when that stock went to next to nothing. It caught Lehman Brothers, Fannie Mae, AIG. The list goes on. Even quality stocks like Johnson & Johnson, Procter & Gamble were incredible put winners for me in the fall of 2008 when those things started to accelerate on the downside. So we're going to come back and show you current charts and look at this overbought, oversold window here. But first I want to just kind of quickly give you the overview, and then I know we're all eager to dive into the platform here. As I said before on weekly options, the basic premise here with weeklies is that, now we get a vehicle as a swing trader to trade in and out over the next week as long as we buy the right type of option. And again, you could sell premium too if you prefer to sell premium, but the first rule of thumb is how to minimize your risk as an option buyer. And then if you're going to sell premium, of course, I would typically sell out of the money options, which I'll do as credit spreads where we're selling. If you're bullish, you'd sell a put, and buy a further cheaper put down below to protect yourself. We're going to keep it simple today and just focus on simple, trend following strategies, how you can buy that, what I call stock substitute position. Now, typically these options are created every Thursday and they'll end the next Friday. So what you'll notice is it used to be that when we go back and look here at this chart, this is a chart going back to the May expiration. It used to be that this is the Friday here, this last monthly option week of the monthly options. They expire, of course, after the third Friday of the month, and their official expiration is the it's a Saturday after the third Friday, in this case the 17th. But what happens now is that every single Thursday you've got this listing happening on the 1st to expire the 9th. The 8th won't actually list because they're already out there on the monthlies. The monthlies behave like weeklies. The 15th they'll list to expire the Friday the 23rd. The 22nd, the Thursday, they'll list to expire the 30th. And so you get a whole range of different ones. And it used to be that they would only list them 1 week at a time. And now you're seeing more and more stocks that actually have multiple weeks of options, especially the really active ones, the Apples and Googles and Amazons and more, that have multiple weeklies already listed for the next 4 weekly cycles at least. So, you really are getting, and as well as the S&P, the S&P may have some of the most between the SPY and the SPX. But, what we're really looking at is, okay, we want some opportunities to take advantage of swings that are driving the markets. Obviously today, for example, we had a swing to the downside. We had, some bad news coming out about Ukraine fears, as well as a plane crash over there that, had some people worried about, is that a terrorist act, et cetera. So, created some downside volatility, and so what we're looking at is, okay, we want to trade them first and foremost on very active names. I don't want to trade things that trade what I would call by appointment, where it's just you versus the market maker. You're much better off to trade things where it's you against a lot of other traders. So we're going to tend to gravitate towards the most active stocks and ETFs that we can see plenty of volume in the options, as well as typically, certainly looking for at least 1 million shares or more a day traded in the stock. So that's a pretty good rule of thumb. Now you'll see just some of the examples of weeklies that we've traded, but the list would go on and on from here. We've added a lot more, since looking at Apple, Baidu, Google, just to name a few, Caterpillar, Gold, of course the SPYs as well as the QQQs. There's just loads of them, and now of course you've had more and more names, like someone mentioned Tesla earlier, TSLA, Netflix, NFLX, the list goes on, Priceline, PCLN, very typically the high dollar stocks. That's what you'll see as a typical pattern there. And of course, what we're looking at on a chart like Apple, this is a past one. We'll look at Apple more recently here because we called it out again when it broke out here after the earnings report back in mid to late April. But you see, it's giving us this initial setup signal here. Let me actually get one that doesn't have an arrow on it here. Right as it crosses that line here, this crossover point is what I call a setup point. That is not where I buy. What I look for is, does it close on past that high? And you see the very next day, it did close on past that high. So you could buy at that day's close. My systems are tested to assume, if you're looking at a daily chart, that you couldn't buy at that day's close because you might pick it up on an overnight scan. So it buys the next bar's open. And so in this case, you see, what is percent R actually measuring? Larry Williams developed it. It's basically measuring where the stock is closing within its recent range of action. And I'm going to give you something here I don't usually give away for free, but I want you to be able to see this. And you can actually plot percent R from the TradeStation preset indicators. It's just the percent sign and then the letter R behind it. Okay, so you can see that over here on the very left side of this page. What I've done, though, is I've changed the setting from the typical, I think 14 bars might be the TradeStation default, and based on my testing, I've made it 30 bars. So, I'm even going to type that in for you. So 30 bars for percent R is what I use. And the point of that is that no matter what the time frame, we're actually saying, look, and you can use whatever you want, right? But my testing showed me that I had a significant edge if I was using daily charts, hourly charts, 15-minute charts. Typically on the biggest growth stocks in the market is where it works the best. So the Apples, the Googles, the Netflix, the Pricelines, the list goes on and on. Chipotle, I was looking at some even on a 15-minute chart recently where Baidu, Wynn Resorts, Tesla, like we said, just a lot of these names, Goldman Sachs, the GLD, gold market, a lot of these big moving sectors that move up and down sharply. So stocks that trade in a range or trade in more of a choppy pattern, like I would typically say a lot of your like heavy duty, economically sensitive industrial type stocks, I tend to stay away from because a lot of those tend to move in a much more erratic kind of like a almost like a trading range pattern. I'm not really interested in that trading range type of a stock. I'm interested in growth. Growth stocks on the way up and growth stocks on the way down. And by the way, you never want to fall in love with any of these stocks. If they made a lot of money for you on the upside, that ultimately doesn't matter. They could also make a lot of money for you on the downside, because when they're in favor and institutions are accumulating, it can be a wonderful ride up. When institutions are dumping, it can be a wonderful ride on the downside. I'll show you numerous examples before we're done here. Now, so what you see happening on this particular chart is what I call the retest. So when this thing comes back on the percent R under the 80 percentile level, and I've got it scaled from a positive 100% down to 0%, more of what I call a grade school scale. Mr. Williams used originally a 0 to minus 100 scale. I just find the positive scale a little more intuitively obvious. We want to have stocks that are what I would call an A plus type of a stock. That stocks that are really surging into the top part of their overbought, if you will, range, but that's staying overbought in this case. You can see that it stays overbought this whole way and gives us two what I call retests. When it tests back under that 80% level, I use that bar's low as a closing stop. You can see it tested again. This was going back to early 2012 when it was making that big move. And by the way, it went a lot higher than this. It ended up going on to 700 with several really nice buy signals in between. This particular signal alone was a really nice one that when it re-signaled there, it kept on rolling up to the 500 range. Now, again, there's no guarantees, and so the risk is, of course, if it actually closes below this level, where am I going to get out? If it closes, in this case, under about that 420 level, that low of those bars, I'll put an X around that level, anywhere down below that. If it's a penny below that level, or if it's 10 points below that level at the end of that bar, then I get out. So that's what I call a closing stop. I don't overreact to interbar action. And so we're going to show you some other examples on the intraday charts. Of course, here's where now you take that daily on the left, and we're seeing now the hourly chart here. Once I'm already on a daily chart signal, and so once the hourly comes in, you can see as it starts to break out here again. Remember, we're just looking at where it's moving near the top 20% of its recent prices. And again, that sounds so counterintuitive, doesn't it? But you say, well, why would I want to buy something that's up near the top 20% of its range? Because that assumes a fixed range. What you see in uptrends is that the range keeps expanding to the upside. So you see that at that point we're getting our buy signal, and you see this nice little run here, and then we took some profits that next morning as it gapped up and said thank you very much. We were getting a 15-minute little quick exit signal there as it gapped up, and while it went up a little bit more, you see it came back down later. So this is the kind of thing that we'll look at today as numerous examples of that. Now, why should I use weekly options? Well, weekly options are going to cost less, and so as a result, because you're not buying as much time, so you're going to get more leverage. And of course, leverage is a double-edged sword. It can work both ways. And so Ron's asking about when's the entry. Ron, let me come back and show you another example here as we go into the live charts here in just a minute. I just want to kind of finish a couple other concepts, and then I want to dive into the platform. But the point here is that if you're looking at a weekly option here in green, you can see this is an example where we were looking at Apple stock, which was in yellow, and it was edging down. And so if you had bought calls when Apple was down just about a 2 or 3%, the weekly options were down about almost 33%. So it was like about a 10 or 12 to 1 leverage ratio on the downside. And then when Apple ran back up, and you see it was up a few percent, then the weekly calls had gone up about 25%. It was about 8 to 1 by that point on the upside. Obviously, that assumes you endured it the whole way. It's even more leverage if you catch it properly. The monthly options, you can see in red, were still volatile too, but not nearly as volatile. You can see they were more like 3 to 1 on the upside at the end of this profile, and about maybe 8 to 1 on the downside when it was initially not moving at all, at the worst of it. So you say, well, and why would I trade that if it's got more downside versus upside? Well, that's again just when you start from point A and track it all the way through. If you give up if you miss on a move initially, you're probably going to, take a little bit more time to kind of regain that ground. So that's why timing is so critical on these. So, as I said before, the difference between an out of the money and an in the money example, if you've got a stock at $21, we've got an example here. And again, this is just for example purposes, you may see that obviously with different situations, it may show you some different results. But this is an example. If you were buying something, say, in front of earnings, which is very dangerous to buy in front of earnings, and volatility is always juiced up, and say it's at 50%, then after the earnings it does move up, and then the volatility comes back down from 50 to say 35%. Well, if you bought the 25 calls at $1, you might make some money on this as it goes up about, you can see almost 15%, 21 to 24. You might see that option go up, but you're going to, on an out-of-the-money option, you need to get a monster move typically to make that pay. So you can actually see cases like this where you can actually catch a big move and still make more money sometimes on the in-the-money call than the out-of-the-money call, because the out-of-the-monies are priced for even more volatility. Obviously, if you get an absolutely monster move, yes, the out-of-the-monies can make you more money in those cases, but they don't happen with enough frequency, in my opinion, to really make it pay off. So, in this case, you're saying, look, if I bought a 19 call in the money, stock's at 21, and say I paid $4 for it, that would be a little aggressive for me, because that would be about $2 intrinsic and about $2 of time. Remember the example I was just telling you earlier is I'd like to probably get about 2/3 intrinsic, so I'd probably prefer to not buy this option that's $2 in the money unless I say paid $3 for it or less. But this is assuming it's juiced up right in front of earnings, and in this case it's saying, well, you might see it go up $3, and of course at that point it might go from 4 to 7. That might even be a little high. Maybe it goes from 4 to 6. That would still be 50%. But the idea is that you might get the same or even sometimes better bang for your buck on an in the money than an out of the money if you get sort of a moderate move, not the monster move that everybody, the speculators, are hoping for. So it's just something to pay attention to. Now, what I want to do is I want to go into the desktop sharing. And so what I want to do is I want to show you, for example, this move that we've had in the big picture S&P here. I'm going to zoom it in. You can really see it closely here. Okay. Now, what we had happen back here when percent R broke out, we've got a couple of things on this chart. Obviously, we've got not just percent R here in this middle panel. We do have the classic Wilder DMI lines, the 14-bar directional movement, blue positive directional movement, red negative directional movement. Obviously, in an uptrend, new highs mean directional movement's going up. On the positive side in blue, it's and higher lows means that the directional negative movement in red is going down. And what that gap leads to is it eventually leads to the ADX, the green line, starting to trend up. I like to see that ADX trending up when you're in a really good trending period. So you'll see some examples of that today as we confirm it with percent R. But going back here to our first buy setup here, it was a very choppy couple of months before this actual buy point here, right? But this is where people kind of get thinking, well, the market's just going to stay choppy for a while. Well, that high back on May 12th when it went overbought. See, by the way, the prior high when it went overbought, we didn't close above there. We tried to trade above there a couple different days after that, but we couldn't close on through that 188.50. So we never got a signal right there, and then it turned off when it came back out of the overbought mode. So when it goes overbought, again, overbought for me is a good thing if it keeps going overbought, if it keeps going up. That tells me that the institutions want to get in. So Ron's asking, when's the entry? So my entry here is that if you get an overbought signal like you do there on May 12th, that high, I'm reading it out to you, probably hard to read on the chart there for you, but 189.88 on May the 12th is the high of the SPY, the spider. This is the vehicle that, of course, tracks the S&P 500. It's extremely active, traded 143 million plus shares here today. But, the point here is that 189.88 is the big number in my book. That's where we went overbought on the high of that bar. We closed a little bit under that, not much. The key that I'm then saying is, okay, is this going to be the top of the trading range, or is it likely to be the start of something more meaningful? You can see in retrospect it was the start of something more meaningful. Well, how did I get signaled on that? Because we got a close above that 189.88 the next day. May 13th, it closed, not intraday trade, but a close at 189.96. So I'm setting up the big picture first, and we'll go look at the short-term swing trade charts to show you how to find these swing trades. So we want to see the big picture daily on a buy. So there's the buy signal. And so the buy is at the next bar is open. You could buy on that day's close if you see it happening right near the end of the day. But if you miss it, as I assume most people would, then I say, well, then just buy the next bar is open. Sometimes it'll gap up a little bit. Sometimes it'll pop down a little bit. But the point is, we're going to buy the next bar's open. So it buys the next bar's open the morning of May 14th, 189.79. Now guess what? It initially is on the wrong side of the market, and that sharp pullback that happens that next day sets up what I call a retest. That's where %R comes back under the 80 percentile level. It comes out of that top 20% of readings. Now, the reason I use %R, I used to, a decade plus ago, use stochastics, another oscillator, right? But stochastics, fast or slow, are still a little too smoothed out, and that's a little too slow for me versus %R, which you can see is a little more jagged. That jaggedness of the line is really, in my opinion, ideal because, you know, I want to see where the flush is, where that retest happens under the 80% level. You see it's now showing me that %R is at 66, about in the, you know, the 66, 67 percentile. So essentially what that's saying is that this close, looking back over 30 bars, is basically in the top 1/3 of recent prices, right? But it's still, so it's off of that recent low, but it's also off of this recent high at that close. And so it's picking up where that close is within that high-low range, okay? So obviously if it closed right at the high, then that would be 100 percentile, right? If it closed right at the low, that would be 0 percentile. You can see came close to that back here at about 2.3% because it didn't close on the low, closed about 20 cents off the low. But that's just a quick primer and %R. So the entry there is on that breakout, and then this is the retest. So the stop is if we close under this bar's low. Now I say this bar, it's a day, so it's on day-to-day weight if you use a daily chart. For you position traders out there, you're just watching it 1 point per day. That's good for you if you're working a day job, if you can't follow the markets all day, every day, to just check it once a day at night even, and then say if you get an exit, get out, the next bar's open, okay? The next morning's open. So you see it tests that. It does not close below that 186.48 low from May 15th. And then actually a couple days later, it pops back up above 80 and back below. So this was a slightly tighter stop, now saying it should not close under 187.07. If it does, we're going to get an exit signal. And by the way, we tend to look at not just the daily, but in context of the long-term chart. We've got a 200-day moving average on here in that light yellow line. That's what made those sell signals not so great, because I would rather take a buy signal against the long-term uptrend and not take a short signal until it actually went into a longer-term downtrend. So that's something to keep in mind too. We didn't take that short signal because of the longer-term trend being up. So this is a way to kind of hop back on the wagon, if you will. So you see then the monster move that happens late May into early June. And guess what? How many times have you missed a move and you say, oh, I'm a dummy, I've missed a move? I do this, so I'm sure you don't, right? But basically I do this where you say, look, I've missed this move. Now it's even outside the acceleration bands in purple, moving outside some long-term Bollinger Bands like blue, saying, gee, I've really missed out on this move. Actually, I didn't. We did really nicely because we caught it back here when everybody was kind of snoozing, thinking, oh, it's just another top of the range. And look, it's starting to run sharply to the upside. There's that ADX headed up as well in green. Nice little combination of things happening there. Well, guess what? I say if you miss that first big run, I say wait for the retest. And so here's the next pullback retest on June the 12th. It'll always be some kind of news about something bad out there, whether it's Ukraine, Russia, whether it's, you name it, some company had bad earnings. We are in earnings season now, so of course that's something you've got to pay attention to. And so I always caution folks to say, be careful about trying to take trades right in front of earnings. Google had earnings, for example, after the close today. So, bottom line is, be aware of that, but don't necessarily try to be a gunslinger and try to trade them right in front of earnings. In fact, almost rather follow them after earnings. We'll show you how we did that with Apple here in a minute. But, so this is the big picture chart. I'm trying to get you to understand this, and then we can go look at the short-term charts with the same perspective. So if you miss that first run, there's your first retest. If you're more of a position trader, this is a key low, 193.11. And you see it can trade under there, it just can't close under there. If it closes under there going forward, then you got to hop out. You see, essentially it's like a stair step or escalator. It's like, okay, your first stop back here, next stop slightly higher, then your next stop's up here. You say, I'm not putting a stop in there every single day. I'm just using what I call the inflection point model, okay? Typically, if I was looking at that and saying it's 193.5 at the close, what option would I buy? if I'm sitting there in mid-June, well, I'm going to look out about a month. So I'd look at the July options, and I'd probably be looking at something like a 190 strike call. So even if you miss that first move, and you're sitting here on that was June the 12th, I'd say, well, what about the 190 strike call? And this is where the option chart comes in, and we'll come back to the chart. So if we're looking at this, which is now near expiration, it's not a buy now, so it's just an example looking back. You'd see you'd buy into that dip on that option. That option was at about, what, 461 at the close. And you see it's trading a little bit below there at one point the next morning. That's okay. But typically what we do is we put some target profits on it. We say, okay, well, if you can get, somewhere between 50 and 100% on a position trade, that's a pretty good move, right? So, what do we say? 461 at the close. We just use that. You could theoretically even use a close under that day's low on the option. 417 would not be good. That would be a violation of percent R on the option chart. You see how the option chart broke out? We don't have the buy and sell signals on here because we don't have enough data. But they're clearly there when we break out here on May 27th and then surge above that day's close a couple days later, May 29th. It's surging through that resistance. You can see multiple lines of resistance, but more importantly, the percent R moving on through that high over 360 on the option chart. So the option chart, you can look at all kinds of different option charts. And if I say, well, if I looked at that comparatively, and you can see, of course, that one goes from, 460, quickly pops to about 660, gets up to about 690. You might have been saying, look, 690, I'd be at a 50% gain. I'd be saying, thanks very much, book half of my profit, raise the rest of my stop to break even, or the next retest key level, which you can see is here at that low, 550. We don't want to see it close under 550. It trades under there, but it doesn't close under there on the day-to-day closes. Oh, by the way, this move today is a violation of the last retest, which just happened a couple days ago. So this move today would be an exit under that 728 level. Today it kind of slammed down under their 588. So even if you bought it on the last retest, as an example, because by the way, you could buy each retest though on the way up and you get 1, 2, 3 nice quick pops, but then this fourth one's going to cost you a little bit. 728 out today at 588. Okay, I like to show you losers as well as winners and say, what's my risk versus what's my reward? There's always potentially 100% risk if you're buying an option that it could go out worthless, right? But if you say, look, if it violates, I can say, look, there's still some time in this one. Now, this one, I wouldn't be trading today as much. I'd be looking out if I was a position trader into August, because we're only now a day away from the expiration tomorrow on effectively the last trading day of these that then officially expire on Saturday. But just following that trade through from its initial inception. If you were comparatively looking, going back for a second to the S&P, when we had that retest, you said, well, what if I had bought a little more aggressively? What if you did buy the, out of the money 195 call, on the 12th? I wouldn't recommend this, but you can see, what's that one going to look like? What did that option chart look like at the time? Well, you can see it was a little too steep. Percent R had come back under and then actually kind of violated a little bit. So while it did go back up to overbought, it didn't really follow through there very convincingly. So a lot more jagged and kind of sideways. Yes, it got a little incremental new high there, but then the big slam down here, this is kind of like playing with fire. It's a little bit trickier of a game in my view, and so that's why I say focus on the stock substitute approach. Now, the S&P chart, by the way, it doesn't show the official exit, but it's actually happening here at today's close, and effectively at tomorrow's open, we'll show the signal. Why? Because you can see what happened here. We had a retest back here on July the 8th. That was at 195.76. We had a gap down last week, a week ago today actually, last Thursday, where we gapped down, but then we managed to recover and close back above that line, 195.76. But look at the close today. 195.71 is a violation of that last retest, and therefore will tell us to exit. That's an end of the prior bull signal from May the 14th. Now, I want to get into the short-term charts and show you some other entries here. So when we were breaking out back there in May, what if you were a swing trader and said, look, let's go down to the hourly chart. Let's really zoom in here. This is what blows people's minds about the way that I look at percent R, and you start to see, holy cow, when this market started to break out back here May 21st, you see we went over bought that morning. And it took a few bars. It didn't close above there until the 5th bar, which is typically about as long as I want to wait to see it go ahead and confirm. It should be getting going fairly quickly over that 188.83. It did it right there, 189.10. So it's telling you buy there, 189.10 on May 21st. Look at how the percent R stays overbought, gives a retest, holds, gives another retest, holds, gives another retest, holds, right? So typically on the first buy, I'd count out 1, 2, 3, 4, 5, and on the 6th day, at the end of that period, I would say you got to hop out there. And you can see actually it did pull back the next morning. Doesn't always work that way. But, I'd say, look, if you really want to end, you'd wait for the next retest. You got 3 of them there. And then it blasted again to the upside, then it retested again, and then you can see soon after that, it exited on the shot down there the morning of the 11th. Okay, so that signal finally ended, and we actually went into a short-term, brief little bear signal. That happens when we break under the 20% level and then close below that low. So that's telling me we're going oversold and then staying oversold. Obviously, that signal didn't work. Told you to short at 193.84, and the next morning, pop back over that 20 percentile level. That's your retest at 194.05, and it exits there at 194.08 or 07. So you're losing about 25 cents or 23 cents. The point of that is, even when you get a buy signal here and then it starts to go and then it fails, 195.39, it's out 2 days later, 195.59. Up 20 cents, guess what? You're not going to make any money on that, especially if you trade options, because of a little bit of time erosion and, a little bit of the bid-ask spread, so that's not really, it's up 20 cents, but it's not really the kind of trade we're looking for. But the point is, that's okay. We say, look, that one you see gets you in and right back out as well. So that's a losing trade right there. So the point of this is that then we have a quick little surge here back at the start of July on the hourly chart. See the breakout happening here? The follow-through is telling you to hop on board there. 196.65. There's nothing wrong with booking partial profits if you get to your first target. Now, as a swing trader, I tend to change my targets a little bit. I tend to go for about a 30% gain on the first half of the position and then about a 50% gain on the rest, because we're only in and out of this over a week. So the bill says, when do I exit? So the idea here is that, look, if I was buying an option right here on July 1st, we're about 197. I might be looking at, say, like the 194 calls in July, the July monthly. So let's look at those, for example, and we'll show you kind of the option montage for on Option Station here in a minute. But if I was looking at that, getting the buy right in here, you can see it's kicking in there about $3.68. Now, you got to be careful because sometimes the percent R on the option chart might tell you it's an exit, but actually I'd be keyed off of this last little low here, 359, and we don't actually close under that. We get real close. It's showing an exit because of that last little retest there, but 359 is never violated. It goes from about 368 up to a high here at about 454. Now, did we get 30%? We wouldn't, right? We would miss that one. So this one you can see is going to come down and give you your exit here at 361. You're going to lose about 2% on that particular signal. Based on what I would do there, because the idea is that, look, we're trying to stretch for that 30% on the first piece, and we end up not getting it, and then there's your retest, and then there's your violation right behind that. So the point of that, and you can see it's been a little choppy here recently, so we do like to look for other confirming tools that tell us are we on the right track or not on the index as well as on the option chart. You can see part of the problem of this last buy signal, we gapped up back here on Monday and followed through, and then we did get a retest coming in right off of this, and it managed to hold on that retest a couple mornings ago on the 15th. So buying the retest, not a bad strategy for what I consider to be a fairly lower risk entry. There's always risk, right? But if you buy a breakout, there's a chance that it could retest right after that and still be a normal little pullback. But the point is that you see it start to move up. It gapped up a little bit yesterday. And you see it shot down today, and that low on the hourly was a key low to watch. That low was 196.86, and there's your violation, 196.66. So it's telling you to hop out there. And of course, the market dropped more into the close. Now, the power of the triple confirmation method is what was happening on the 15-minute chart. If we put that side by side, you can see we were initially getting that breakout signal on the 15-minute chart as well. back here on Monday. And if you follow that through, you can see that on Tuesday morning, the 15-minute chart gives you a 15-minute exit. Why? Because that pullback low was taken out with the follow through right underneath it there on Tuesday morning. So the 15-minute chart is telling you to hop out before this little sell down here. It's not telling you to go short right there, just saying get out of your longs, and then it tries to short right there. Again, the short on a 15-minute chart when the daily's still on a buy, the hourly's on a buy, I don't feel like trying to fade the market when the other two longer time frames are bullish. I'd like to line that up. I want to show you how I look for these here in a second too. So, but you can see it clearly, even on the pop-up yesterday morning, when it goes overbought and then it fails to get through that high, that's a failed confirmation. That is the top of the trading range on the 15-minute basis for you quick traders out there. And then you can see it tries again, gives a little buy there late in the day yesterday, and then quickly knocks you back out. Why? Because the retest low was violated right behind it. So you can see no money being made there, maybe even a hair loss there, 8 cents down on the SPY from the entry. But the point is that it gets you out before this action. And then you see what happened today. We went into sell mode. And again, it still tried to sell and then bounce. So it's tough when you're trying to short a market that's not really actively bearish on the longer time frames. It got another signal down right before the close, about 3:15, 3:30 here, confirmed, as it went oversold. You see that ADX was starting to move up, had that little bend in it, but didn't really break that bend high. So that was still kind of a resistance on the ADX. But the point of this is that, yeah, the 15-minute chart didn't look so hot. And you can see, actually, the hourly chart was just starting to break down here at the end of the day on the ADX. And that's going to be an official sell signal on the hourly there, too, into tomorrow's open. So unless we gap way down, which I really wouldn't want to chase, we would probably have a little bit more sell pressure now that we have a 15-minute and a 60-minute together. And now that the daily is going to give us an official exit at tomorrow's open. Am I predicting any crash scenario? No. Because, again, anything's possible, but the point is that an ideal spot would be if you had an early bounce tomorrow, we would get a retest on the 15-minute, perhaps even the hourly. The early bounce scenario would be one of your lower risk bear entries for this quick kind of a trade on the downside. So if I was looking at that, and again, these are not recommendations, but just if you went into, say, an Option Station Pro as one of my preferred tools to use there in TradeStation, you can look at a lot of analytics, right? I wouldn't be messing with the, front week options that are going to expire tomorrow. I would be very aggressive, but I might be looking at the weeklies that expire next week, right? Next Friday, the 25th. You can see these are in units of 10 or 100. I look at the 100 share increments, so one contract controlling 100 shares. And you say, okay, so if I'm looking at the options montage real quick here, we're about 195.5. And you say, okay, I don't want to buy the 195.5. That's the one that's got so much time, or what we call theta risk. That's got a lot of time decay in it right there. Okay, so I'm looking in the money. A couple of rules of thumb. I said I want to find something that's got at least 2/3 intrinsic value, right? So I might look at like the 197. You can see based on the after hours quote here, and again, you've got to factor in that we're down a little bit after hours, so this option will probably be trading a little bit higher. So the more accurate view would actually be tracking it against where it closed, which let's just be official about it. The close, 195.72. You can see we're down about 37 cents after hours. Let's use 195.72 as our comparison price, because that's really the fair value. And say, well, that's 197. It's like $1.28 in the money. That's not quite deep enough in the money for me. So I might look at a 198. So, okay, now 195.72 close. It's like what, $2.28 in the money. You're paying $2.62. That's more like it. Now you can see that shows a very high delta. It's showing a delta of practically a 1-for-1 inverse. -1 means, of course, that it's moving almost point for point up when the index is moving down. So that's a very, very high delta, right? But the point here is that, okay, look, if we're buying this option for $2.62, delta is not quite going to be truly 1. It's because you're paying a little bit of time value. But at $2.28 intrinsic, and say you pay the ask at $2.62, then you're basically paying what, another 34 cents of time, 34 cents out of your $2.62. is what? About somewhere in the neighborhood of about 13% time value. Thus, you have about 87% intrinsic value. That's a really good ratio, right? I'm not saying you should go out and necessarily go buy that option, but I'm saying that's the type of option that I would be looking at. And then again, you can look at the option chart, et cetera. Now, how do I find these trades? Again, I want to show you a little bit of that before we're done too, and we'll try to look at a couple of the stocks that you all posted before we're done too. So quick review of that. RadarScreen is absolutely essential to me. Okay, that's a requirement that I have to have up. Now I have my Big Trends indicators custom coded in here. We call it our Big Trends Toolkit. If you'd like more information on that, you can always drop us an email. I'll put an email up later, or you can call our 800 Big Trends line. But percent R bull scan, so looking for bull trades and bear trades. I've got it color coded, and this is the hourly chart. So we'll look for some swing trades on that basis. So if I'm looking at, obviously today the market was kind of breaking down late, so you're going to probably see a few more bear signals than bull. Now when it goes green, that's a bear confirmation. That means we went below the 20% line. That's where it goes yellow, saying, hey, we're below the 20% line on that particular hour, 2 bars or 2 hours ago, because remember, it's all based on your interval. You can format your symbol and change your interval as you wish. So I could format symbols and format all symbols. My mouse doesn't act up. And say, look, if I want to format these symbols and say, I'd rather look at a daily, I'd rather look at a 15-minute, I can change any of that. I wouldn't go on tick by tick or second by second. Your head might be spinning. But, I'm staying with the hourly chart here. But it gives me some candidates. I'm not saying I should go blindly go, buying puts on all these, but I'm saying I want to, develop a watch list. So it's sort of like fine-tuning, as you look across multiple time frames. So we had TSO, Tesoro, the oil refiner, going bearish. We had American Airlines on the hourly going bearish right at the close. We had ADM, Archer Daniels Midland, going bearish. So you can see what do these stocks have in common? Most all of them should be over 1 million shares traded a day. Okay. Sometimes you'll see like a stock like Chipotle. Part of the thing about that one is it's a $582 stock. If it was a $58 stock, that'd be equivalent to 4 million shares traded, right? So, I do look at some of the high dollar stocks as well for this method. So you can see quite a few of them signaling here late. Deere was another one, DE, going green on the bear side. These are the bear scans, remember. So Disney was another one, of course, the Dow stock, BP, and BTU. And so again, just building a list of potential candidates. These are not specific recommendations. It's just starting this process of starting to go through and weed out different opportunities. Were there any on the bull side? Probably some of the inverse ETFs, right? Well, here you go. Gold, Agnico Eagle, AEM, okay? FAZ is the bearish financial ETF, SDS is the bearish S&P. So those, of course, were going bearish. So there's Barrick Gold, ABX. So you see a trend happening in gold. Oh, by the way, there's the VIX, the VXX tradable volatility. Surprisingly, a stock like Goldman is relatively strong, trying to give a setup for a buy, but it's not followed through yet. So Goldman stronger than most, but certainly not one that I'd be buying here. Intraday, we were looking at CF even before this market tanked as a candidate on the buy side. So if you're looking at these, before the market tanked, looking at CF this morning, you see that CF really was rocking and rolling yesterday, and even the day before on the 15-minute chart, roared again today, and then was giving an exit late with the market weakness, right? So you see how overbought can stay overbought even through some tricky markets. That was one of the stronger stocks today, but is now done on the 15-minute basis. The hourly chart is also now violated because it closed under that 251.5 level, okay, from the prior hour. See, the daily chart didn't quite, it did confirm actually, so daily will give a buy tomorrow, but we'd be wanting to get all these other time frames lined up. So I'm back on the bear side. Oh, and by the way, we said gold was starting to surge. Obviously, if we looked at the GLD, you'll see that one's moving up some. The gold market starting to pop up on a little bit of fear, perhaps. And we talked about the volatility index, the VXX is another one that was starting to pop up. It's been dead money for quite a while. And guess what? That's a huge surge in a very short period of time for the volatility index. One of you mentioned you tracked VIX. I also tracked VXX as a tradable instrument. It's up almost, 9% today. obviously the option chart would be up even more. But when we were mentioning AEM for the couple of those gold stocks, so the gold stocks, there you go. There's the buy signal coming in right at the end of the day on AEM. Oh, by the way, the daily chart's been on a buy, right? That's been a beauty. So you get the daily lined up with the hourly, with the 15-minute, and that's a triple confirmed type of a signal that we tend to look for at big trends. Again, not a recommendation, just giving you examples of the kind of things we look for. ABX not quite as strong as AEM because the daily was violated, and so it's just now getting going again. So AEM's been stronger in comparison. I'd always rather trade the long stock than the leading stock for a long on the way up, and also the weakest stock on the way down. So and Ron asked, what are the color rules? So again, the green means we're getting a confirmed signal, bull or bear, and red is what we would call a retest. So if it's been above 80 and then it comes back down for a retest, like Goldman, it looks like might have been giving a retest on the hourly, right? So it's coming back under that 80% level after having been above it. So that might reset. Yeah, it's on a buy. There's your retest. So it's telling me, hey, be aware there's a retest on Goldman bullishly here. So it's saying that low in that 2:30 to 3:30 hour Eastern was just under 170 would be your key low. It didn't close underneath there, so it managed to hold that low. So that's the retest low for the current buy signal on the hourly chart. And that one actually is holding technically on the daily as well as, no, it's not quite there on the 15-minute, right? Oh, not surprising because the market was so weak. Okay, and yellow is just a setup, remember? So yellow is just looking at, okay, if we're going above that 80% level, that's what we call setup. So that when it comes back above 80, that's telling me, okay, guess what? It's getting ready, perhaps, to go, but it doesn't mean that it's necessarily going. You'll see a lot of times where it goes yellow and then it doesn't go green, like PBR. So, that you look at these examples where some of these were setting up midday, a few hours before the close, and then they were rolling over with the market rollover, so they never gave you the signal. That what I call confirmation method, and the failure of confirmation in some of these cases saves me from a number of whipsaw trades. You're still going to have losing trades, but it's going to help you to minimize those in comparison to trying to really ride out and find the better trends, like what I showed you on CF, among others. Now, we had a couple others people were asking about, like Tesla. Quick little few-minute rapid fire before we wrap it up. So you can see Tesla kind of breaking down on the 15-minute and the hourly here, the left and middle panels, 15 and hourly, but the daily on the right on this one, you can see is kind of in a no man's land. It's sort of holding above a 50-day. It's well above the 200-day. It's kind of choppy there. So, obviously, if you're going to trade a stock like Tesla in options, you're going to pay a pretty good premium to buy those options. You need to make sure you get them really lined up. So for me, I'll tend to kind of wait until I really make sure that. I mentioned Apple earlier. Apple as an example of one that was very good to us from the April buy, after the earnings. So I didn't buy in front of earnings. I waited. There's the earnings gap back here in April. And then there's the confirmation the day after the earnings gap high. We closed above it. This is, of course, now adjusted for the 7-for-1 split. The daily is confirmed, the hourly is on a buy, and your 15-minute on a buy. It's like, hello, all three time frames on a buy, and then look at how that raced on the 15-minute when the hourly and daily were on a buy. Beautiful initial surge. And again, you can keep coming back to it. So you can see you get multiple opportunities as we just scroll it forward here. Say, look, we're on this monster daily buy signal, and look, it's pretty much keeping you on the right side of the market. Sure, the 15-minute tries to give a sell every once in a while. I'm not going to take that if I'm on a big monster buy signal like this. I told my workshop students to buy Apple right on that daily chart retest there, and it just popped right up off of there. We actually bought the next retest and got stopped out. So we bought that next retest. 91.90 had to hold. It didn't. 91.28. We got right back out. So look, if you catch it right from a retest here just around 83 bucks and it runs up, we ended up selling it out here somewhere in the neighborhood of about 90, right? So, let's just say you catch it for, say, even we'll call it 6 points, and then you're wrong here for just under a point. Call it a point. So if you could win 6 and lose 1 and do that 50-50, even do that less than 50-50, you're going to make a lot of money. Even if you did that 33% of the time, you made 6, you lose one, you lose another one, you'd be up net of 4 on 3 trades. That's making you good money over time. So the point of this is that it does the classic goal of all trend following systems. Let your winners run and cut your losers quickly. You read it in every textbook, right? But then you don't know, they don't tell you how to do it. So this is giving you the guidance on how to do it. Okay, last one here. Walter asked about the Russell. You can see here the Russell has really lagged, right? It's really been coming back down hard. It's interesting how it kind of came up in that long-term band in the light blue line, and then it just totally stopped there. And by the way, that was not a new high. That was kind of like a retest of the March highs, whereas the other indexes, like all of them, were the Dow, the NASDAQ, and the S&P were making new highs. So the Russell has really lagged, just closed under the 200-day today. It's not on an active sell, though. You can see today is now a breakdown, but it's got to close under today's low to go back into a potential daily sell. So it's been weak on the short-term 15-minute and 60-minute, but if I was going to trade that, I would trade it smaller, Walter. So if you don't see all 3 time frames lining up, but maybe you get 2 out of 3, the other one's kind of mixed, maybe you trade it as a partial position. So that's a way you can kind of get a little bit of exposure if you feel good about it, but not go too heavy. It's always important to make sure you're managing your capital wisely. We never recommend, even when you're really lining up all 3 time frames, we don't like to overcommit our capital. We're always going to stay very balanced and very, much looking at it like a process over a long probability of trades, not trying to hit it really hard on any one trade. That's what gets a lot of traders in trouble. So be consistent and be reasonably conservative on your capital allocation, and that'll help you a lot. Now, I did want to just mention here that before I hand it back over to Mike to wrap it up, because I'm past my hour, I don't want to keep them too long. We set up a special freebie offer for you coming in as a TradeStation attendee, and we set it up through the special website page, bigtrends.com/free. And it's pretty easy to remember, right? bigtrends.com/free. I'm just going to drag that page on there real quick to show you what you get. When you just put in your first name, email, phone, you can see here that you get a lot. We give you access to what I call my Big Trends Insider access for a free lifetime membership. You can get regular daily educational emails, or you can get them weekly if you want, but basically you can see what I'm trading, what I'm teaching my students at Big Trends about. You also get this free technical analysis ebook, and you get all kinds of other goodies, including invitations to future webinars. If you like webinar training, you'll learn from me over time with other webinar invites over time. So just go to bigtrends.com/free and check that out. I think you'll really enjoy that. Okay, I'm going to hand it back over to Mike to wrap it up. I want to thank you for being with us today. It's always a pleasure. I love using TradeStation and showing you what I'm doing in the platform. If you have any questions, give us a call at 800-BIG-TRENDS, or you can also drop us an email through clientcare@bigtrends.com. So take care, everybody, and let me hand it back to Mike. Have a good one and trade them well.
Thanks, Price. Great as always. Thanks, everybody, for attending. Make sure you take a look at the online calendar of events. There's always something great coming up. See everybody at another event. Have a great evening. Thanks, everybody, for attending. Thank you, Price.